In this short video, I'm going to talk about whether to invest in real estate, stocks or shares. It's one of the most common questions I get asked by new investors. Why do you choose to invest in property over stocks, and why stocks over property? Hi, my name's Mark Lloyd. I'm co-founder of Property Master Academy and I've been investing in property since 2005. Now before I start, I just want to add that I'm not giving financial advice and everything in this video is just my opinion. So let's take a look firstly at returns. When you compare the long-term returns of stocks and shares, what I mean is something like the FTSE 100 or the Dow Jones Index, which essentially are a group of companies. And most people, when they first start buying shares or stocks, which really means, by the way, the same thing, a lot of people will buy an index fund. So that it mirrors these indices. And if you look at the long-term returns, they are actually very similar, with a long-term average of around 7% per annum. And most indices are the same. In fact, if you look over the last 20 years, you'll find the growth rate is very similar. Like most investments, they have market crashes and market highs. The difference between stocks and shares and property is that property often takes longer to recover from a crash, but it will rebound stronger. After all, property was hit quite badly in 2008, but last year in the UK grew over 10%, with a long-term average of between 7 and 8% per annum. So in terms of returns, it's very hard to distinguish which is better. But I'll talk about return on investment later. So what about the longevity of the investment? Because when you look at investing, it should be for the long term. Anything short term is just pure speculation. I should just add that whilst I invest in property as my main investment, I also invest in shares and crypto, as it makes sense to spread your risk over different markets. Where you start will likely depend on the amount of cash you have. If you have just say £10, then whilst it's possible to start in property with very little money, it's more likely that you'll invest in shares or crypto. But you could still invest in property through a real estate investment trust, often referred to as a REIT, that's R-E-I-T. If you want to look at low money in property investing, then check out my other videos where you can start with very little money. So the next thing I like to look at is risk. How likely is my investment going to perform over the long term? Now this risk could be inflationary, it could be economic, it could be equity. In other words, how likely are you to lose your money? It could be the effect of interest rates, or there could be currency risk as well. I would say that one of the biggest risks is inflation, because it erodes the value of your money, so when you're investing, you want to try and make sure that you're making above inflation rates of return. So if I have £10 today and inflation is 5%, then in 1 year's time, that £10 will now be worth £9.50. So as a smart investor, the number one priority is preservation of capital. In other words, I want to make sure that my true wealth is increasing above inflation. Now, when it comes to property, inflation is kind of your friend in many respects, as inflation increases the value of the property whilst your debt, your mortgage, either stays the same nominal value or decreases. Now, this last bit is called leverage, and that's what puts property investing above any other type of investment. But I'll come on to that shortly. One of the biggest factors that affects short-term market sentiment is the news, which is one of the reasons why I rarely watch the news, but also because news affects short-term market moves, and I only invest for the long term. Short-term investing is called trading, and you need to be very experienced to make money on any short-term market movement. This applies to stocks, shares, crypto, and to a degree property. Short-term investing in property is considered to be 6 to 12 months, when a lot can change. Now, if you're the type of person to worry about short-term price changes, then you should avoid stocks, shares and crypto. I own all of these. I rarely look at them. There are several ways of making money in property, but if we look at it as a long-term investment, then there are three main ways of making money in property. Firstly, you've got capital growth, assuming you've bought in the right areas. Now, capital growth is not a given, and in my mind is the bonus of investing in property over the long term, because you can't spend it until you've sold it. So that's why, secondly, you've also got rental income. Now this comes in on a monthly basis, usually so is your cash flow, which makes it different to most other types of investments. Stocks and shares usually pay out an income once or maybe twice a year, and crypto doesn't pay anything out at all. And then thirdly, you've got the inflationary impact. It adds value to your property, but devalues your mortgage on it in real terms and increasing rentals. Now we have an undersupply of properties in the UK, which means we have increasing values and increasing rentals. And this doesn't happen with stocks, shares or crypto, as their value is determined by short-term indicators. And just because you receive a good dividend 1 year doesn't mean you will the following year. So if you compare the different types of investments, property investing usually wins, but historically it's at a high entry level. In other words, you've needed more capital to invest in property than anything else. The other area where property also wins is that it's relatively easy to understand, as everyone lives in a property, and therefore property is a more universal type of investment, whereas not everyone understands shares and so on. Now, one could also argue that it carries less risk as you have a physical asset, unlike stocks, shares and crypto, which are paper or digital assets. The old saying is that you can't beat bricks and mortar as an investment. Okay, so there's some of the advantages of investing in property, but what about the disadvantages? Well, the biggest one is that property is illiquid. In other words, so if you own a property that's worth £100,000 and you need to raise £30,000 on it, then it's not a quick process. It will likely take you several months. On the other hand, stocks, shares, crypto, you can just go online and sell in seconds. So if you're going to invest in property, then it makes sense to make sure you have some liquidity, whether that's in stocks, shares, crypto, or just cash in the bank. The second main disadvantage of property is that there is more involved in the buying process. For the others, you just select the stock, you buy them after, of course, you've set up your account with the relevant provider, and apart from the initial setup, which can take a few days, it's very quick. With property, you can't just say, I want to buy that property. You need to put an offer in, hope it's accepted, then there's the valuation survey, arrange mortgage, solicitors, searches, etc., etc., which can take several months to complete before you even own the property. And once you own it, then you might have refurbishment to do, find tenants, deal with maintenance issues, and so on. Got the picture? So it's a lot more involved, but also potentially more rewarding over the longer term, which leads me on to leverage, which I touched on earlier. Now, it's normal to leverage with property, but not so normal with stock, shares and crypto. You can leverage these, but I recommend against it unless you're a professional and you really know what you're doing. So with property, it's normal to take out a mortgage. Now let's say you have £100,000 to invest. Quite simple with stock, shares and crypto. You end up with £100,000 worth of these things. But with property, because of the mortgage element, you will end up with £400,000 worth of property, ignoring expenses. But that's not the main advantage. The really big advantage is in the inflationary and capital gains impact. So let's say the value of the property goes up 10% as an example. It's not 10% on the £100,000 you invested, it's on the £400,000 that you've now got. So you've actually made a 40% return on your money, not just 10%. And what makes this even better than other investments is that banks are happy to lend on property to help you grow your portfolio. Whereas with stocks, shares, crypto, they are very reluctant to do so. The banks will literally give you millions. They will actively help you build a portfolio. Well, hopefully I've given you a few ideas as to where you want to invest, but also check out my other videos on investing 10, 50 or even £100,000 in property, as I'm sure it will open your eyes to the wonderful world of property investing in the UK. If you've enjoyed this video, then please hit the like button so that people like you will get to see this video too, and also hit the subscribe button so you get notified of other videos as we upload them. Appearing on your screen right now are some other videos that will help you in your property journey. Thanks for listening.